Welcome to PhillipCapital Weekly Market Watch. I'm Yin, Business Development Dealer at Phillip Futures. For this episode of Market Watch, I'll be discussing on the performance of the gold in 2016 first quarter together with the technical analysis. This will be the outline of the Market Watch today I'll be talking about. First of all, I will just go through the summary of gold performance in 2015. So the precious metal has been in a slump in the 2015. Gold, long considered as a haven during times of geopolitical turmoils, failed to sustain brief gains following the November 13 Paris attack. Even the events such as the Greek build-up negotiations in July and the downing of a Malaysian passenger jet by the Ukraine in 2014 sparked some demands. However, investors have mainly shunned away from buying the precious metals. Gold slumped the day after the Fed's decision to increase the interest rate hike, hitting a new 6-year low of 1,050. So this is the 2015 chart of the gold performance that you're seeing. The precious metal has been in a slump for the half of the 2015 and is unable to climb back to 1,200. It hit a low in the early December, trading at the price of 1,046 after the Fed's announcement. So now let us look at what the potential factors in 2016 that can affect gold performance. First of all, we have seen that there have been political unrest in the Middle East region. Rising tension between Saudi Arabia and Iran boosted gold's appeal as a safe haven. With the investors in view of the Shenzhen Stock Connect to be launched in near futures, more demand on the gold is expected as it is perceived as a safe haven precious metal. However, the weak Caixin market data reading below 50 also indicated that the slump in the China market will most likely continue. Moving on, gold have been falling for the past year as the dollar climbed as the Federal Reserve is poised to keep raising the US interest rates in 2016, cutting the appeal of the bullion as a store value. The gold performance is likely to be determined by the pace of the rate hike by the Federal Reserve in 2016. As the Fed is planning to perform 4 interest rate hikes next year, should the inflation begin to move in its favorable target, speculators are observing that there will be a faster pace of tightening than the currently predicted by the market. This will push the gold demand even lower as the precious metal does not respond favorably to the rate increases. So what is the focus for gold in 2016? Looking into this year, the focus for the precious metal is still bearish as the downtrend track is still continuing from the past 5 years. Gold demand is spurred when there is a turmoil in geopolitical unrest, and the Middle East unrest did spark some demand for the gold. However, the outlook for the gold in 2016 climbing back to 1,200 is very dim. China's central bank cutting the reference rate has the spillover effects on the Asian stocks as we see heavy sell-off in the markets. Moreover, with yuan currency officially inside the IMF reserve basket, we expect this will be a bearish sign for the precious metal. Now that the Fed has decided to raise the interest rate, speculators are still looking out for the pace of the interest rate hike in 2016. Moving on with the technical analysis, we can see that the gold has been bearish in the trend for the past 5 years, hitting the lowest in 2015. The precious metal hit the low when the Federal Reserve decided for the rate hike in late December. From the above 5-year gold spot daily chart, we can see that the metal has been trading below 1,200 for the half of 2015 and showed no signs of bullish trend. However, the start of the new year, the metal is welcomed with a new record high by breaking 1,100 resistance after the China week PMI data is released. In short term, gold will be under demand due to the political unrest around the world and also the China weak economy. However, the downtrend is expected to continue in the long term as the investors are concerned on the pace of rate hike by the Federal Reserve in 2016. For the first quarter, gold is expected to be supported at 1,050 and the immediate resistance at 1,150. To conclude, I believe the outlook for gold for the 2016 will be bearish. Fed policymakers in December have raised the benchmark rate for the first time in almost a decade. This move has triggered the investors to damp the metal all year in anticipation. With speculators now focusing on the pace of the rate hike, the appeal of the safe haven metal looks dim. There is a bit of tension between the Saudi Arabia and Iran, however, that cannot push the gold's appeal back to the 1,200. The macro factors are against the gold at the moment. The dollar is strong, the real interest rates are going up, and the inflation expectations are very weak. These are all negative for the gold. With this, we have come to the end of this week's edition of Market Watch, where we have discussed gold performance in 2016 and also the focus with technical analysis. For more information on the risks and returns of investing in gold, you may approach any representative from Phillip Futures for a further discussion. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos. Thank you.